So today we're talking about the 5 things that you need to know about your life cover if you have life cover or you're planning to take life cover in South Africa. Hi, my name is Yolanda. I am a financial advisor, and it is my goal on this platform to give you easy, actionable tips, content, and strategies that you need to manage your money well, to live abundantly, and build generational wealth. If you're new here, please remember to subscribe to the channel so you'll never miss out whenever I put out a new video. And also like this content, please. It would really help me reach more people like you that want to know about wealth building in the South African context. So today I'm going to give you these 5 points that you need to be looking at if you're currently looking for life cover. If you currently have life cover, I want you to go and check this out in your policies to make sure that you have it. Or if you do have it, how you can change it into something more positive. So I'm going to use 2 terms here in this video, life cover and risk cover. So in this umbrella of risk cover, where we look at things like dreaded disease, income protection, disability cover, one component of that is life cover. And the 5 points that I discussed today is going to cover all risk cover. It's just that terminology-wise, I'll just slip in between risk and life cover. And if you stay with me to the end, I have a bonus point that you do not want to miss. The first thing that you need to look for when it comes to life cover is premium patterns. Companies are very sticky with this. I don't know why, but they give various premium patterns that you can select in the policy. And it's usually the advisor that sets this up. And the first type of premium pattern is called the level. Now, each company will have their own terminology, but the working behind it is very much the same. So with a level premium pattern, you know that benefit is not increasing. Sometimes the benefit will stay the same, but the premium will increase. And that will be an inflation increase. Because if you're paying 100 Rand for a million Rand cover, you can't pay 100 Rand for a million Rand cover next year, because that 100 Rand does not have the same buying power as it did the year before. There has to be an inflation increase on the prices, but your cover amount is staying the same. Now, the gap with that is a million Rand today is great, but a million Rand 20 years from now is not so good because it will not have the same buying power of 1 million Rand. The next type of premium pattern is inflation linked, where the premium increase will happen according to inflation for that year. I think this is a little bit fair, because if we had a 7% inflation, you can effectively get a 7% increase in premium, just the premium side on this one. The benefit side is actually the second point, and we'll come to that. And then there's the age-rated, which is a horrible premium pattern. With age-rated, they give younger clients a really good discount upfront. And what I don't like about the age-rated premium pattern is that as you age, the increases are not even incremental, it's actually exponential, which means there's bigger jumps in the premium increases as you get older, which is very much a pain. And for me, it doesn't leave a client in a good position, because when you're older and you need the cover, you are struggling to keep up with the payments and you're most likely to cancel. And I don't want this for my clients. So it's not a premium pattern that I would recommend. What's nice to have with premium companies in South Africa is ability to change premium patterns. So you could easily start out as age-rated and get that good rates. And as you age, you can switch premium patterns, because your life does not stay the same. Your needs change. And it's nice to have a risk solution that changes and adapts to your needs. For example, if you're young and you get an age-rated price on your risk cover, great. As you get older, you go through the various life stages, marriage, kids, if that's what you want. But when you're older and those kids are financially independent, you wouldn't need life cover. At that time, it would be nice to level things out, reduce it and level things out, to leave a legacy instead of your family being dependent on you. That adaptability is nice, and I hope you have that in your life cover. If you need that in your life cover, make sure your advisor gives it to you. Next is a benefit increase. So when it comes to your price, know that there's an inflation price increase every year, whether your benefit increases or not. Then there is the benefit increase, where if you want 1 million Rands, but you want to keep up with inflation, you want that 1 million to keep up with inflation, then there's an additional increase. All right. And that basically makes up your premium increase in your annual pricing. The benefit increase, very much same to the first point of the premium pattern, where your benefit increase can be level, stay the same, but obviously your premium will increase because of inflation. Or it can be linked to inflation, or you could have a fixed rate of increase, maybe 3%, 5%, 7%. And again, also nice to be able to change those benefit amounts without underwriting for when you need your more risk cover. The next thing that you're going to look for is guarantee periods. And I know a lot of people don't look at this. And you'll find that the pricing guarantee period, it will come in blocks of 5, 10, or 15 years. And usually a company will give you a 5-year period and a really good rate for those 5 years. And then after the 5 year, on year 6, there's a substantial increase in pricing. What we want is a longer guarantee period, because then you know for the next 10 years, next 15 years, this is what your price is going to be. Because after that guarantee period is over, there's a review on your risk, and then there is a price adjustment. What I've noticed with clients is the banks give you the smallest or the lowest guarantee period of 5 years. And then after that 5 years, there's a significant increase in pricing. So that's not ideal for a client, because now you feel like, oh, I'm in this for 5 years and now there's a big increase, and how do I get out of this because I need the cover? Whereas a comprehensive premier company in South Africa will give you a nice 10 to 15 year guarantee period. The fourth thing that you need in your risk cover is the ability to pause your cover. We all go through financial hardships. Okay, nobody is exempt, whether you're a billionaire or broke. We all have our times. We all have different problems with our money, but we all have difficult times. And when those difficult times comes about, the first thing to usually be cut is your life cover. But what if you had the ability to pause it? Have some time to get yourself on your feet again and then restart. Instead of canceling it, struggle, and work your way out of your situation. And now you need the life cover. Now you're being underwritten when you're older, when you may be sicker. The body might not have been in a good shape as it was when you took the first cover. The ability to pause it gives you that downtime, gives you that breathing room you need to financially maneuver to get back to normal. And then you start your cover again. Now, one of the downsides to that is if you have to make a claim in that freeze period, you will not be paid out because those are the terms of the agreement, but at least you'll have that option. Instead of canceling and then taking it at a later stage, that's more expensive. Now you're probably thinking, okay, I can only afford 700 Rand, but 700 Rand when you are 30 years old and 700 Rand when you're 47 buys you two very, very different products. And at the 47, that 700 Rand will buy you far less. So you don't want to be canceling, chopping, and changing too frequently, unless you're getting some serious value somewhere else. And it's a very, very competitive life insurance space in South Africa. The fifth thing that you need in your risk cover is the ability to future buy. And this is especially needed for younger clients. Because if you're somebody who's financially savvy and you realize, hey, I need life cover in the future for when I buy my home, when I have my children, or for my siblings or family that are depending on me, but I just don't need it now. So why do I have to pay this premium now? Let me take it later when I need it. Okay, the problem we have with that is with life cover, you get the best rates when you are younger and healthy. But in South Africa, you have that ability to future buy your cover. So you're 25 years old and you're financially savvy enough to speak to a financial advisor that puts this product in place for you. And usually what I do here with my younger clients is I'll give you bare minimum. All right, if you don't need it, you have no kids, you have no dependents, you have no assets, I'll give you bare minimum like 100,000 and you pay like a 8 Rand, 9 Rand on it. Then I'll put the future buy feature on that policy. You pay maybe 30 Rand for it. And then as you age, as you marry, as more people become dependent on you, as you gather more assets and you want to leverage life insurance, that's when you start unlocking it. And when you do start unlocking it, you're underwritten at the time the policy is in place. So if you take your extra cover, a million Rand cover at age 30, you'll be underwritten at age 25 because that's when you started the policy. And young people are not going to see the value on this, but speak to people in their 40s and 50s that cannot get life cover because it's so expensive. Remember that life cover or risk cover is bought with young age and good health. The earlier you get in, the better it's going to be for you. And you don't even have to pay a full premium. You future buy what you need because you're young and savvy and you're watching a video like this. If you're getting value, please hit the like button and don't be scared to share our content with friends and family as well. So these are the little nitty-gritties of risk cover in South Africa that you should be looking at. And I know we all have to be looking at price. We all want to be frugal, but I urge you to shop on value and not on price when it comes to life cover. Because I'm pretty sure these 5 things that I spoke about, you probably haven't heard about them. You're just looking, when you buy life cover, you're looking at how much am I going to get and how much I'm going to pay. But the in-betweens of how much you're going to get and how much you're going to pay, that's where the value lies. And that's what I want you to be looking at as a financially savvy person. So here's the bonus. But before I give you the bonus, if you want to know how you can use your life cover to be your own bank in South Africa, check out this video. And bonus number 5 is those cashbacks that all of the insurance companies are promising you. If you are with a life company for the cashbacks, look at the fine print and you will see a nice little marketing fee there, maybe on page 6 or page 7, when you're fed up of reading page 1 and page 2, and then you blast past everything and you sign. You'll see a marketing fee there, something crazy like a 3% a year, 4% a year for the next 25 years. That is so much of money. So you are in fact paying yourself your own bonus when you could have taken that 3 to 8% a year and put it away in a tax-free investment or a unit trust and make some real money.